Do you want to invest more when everything in the market is on sale? Or are you just going to wait again? Welcome back to our Investing for Complete Beginners series. I'm Joyee Yang, a 26-year-old investor with 6 figures in assets. In this video, I will give you a simple, actionable plan to start investing during the stock market crash. The stock market has been dropping in 2025 due to tariffs and geopolitical concerns, but guys, let me get this straight. A bad market is the best time for you to start learning how to invest the right way. This is the only time when beginners are not tempted to enter the market due to greed or FOMO. And nobody is telling you to chase Nvidia stock or Bitcoin because they are not going to the moon right now. That's why this is the best time to get started without any bad habits. And it's okay to feel intimidated as a beginner when the stock market seems really bad. My goal in this video is to help you understand why investing is not about waiting for the best timing. You will learn how to take action now so that you can start building wealth through investing. If you have already been investing, this is the time for you to put more effort into your investment planning, because this might be the best time for regular people like you and I to multiply our net worth. I'm not going to quote Warren Buffett because you have probably heard this quote like 50 times on the internet, so let's get straight to the point. If I were to restart as a complete beginner in the current market environment, I'd only focus on 2 investing goals: buying stocks and ETFs in 4 defensive sectors: energy, banks, groceries, and healthcare, and then dollar cost averaging into long-term bullish assets. Friendly reminder, you can save this video or tap the like button so that you can find me again when you need a revision. What is a defensive sector and why should you invest in it? If you've never heard of a defensive sector before, defensive sectors are basically industries that perform better than others during a recession or market downturn. The reason is that no matter how bad the economy gets, there are some things people still need to spend money on. You still need gas for your car, electricity and groceries for your home, medical care, and you still use banking services. These industries tend to be more stable when the rest of the market is crashing. In fact, people naturally want to ensure they have access to essential services and necessities whenever there is a crisis. That's exactly why investing in defensive sectors can help protect your money in uncertain times. It won't make your portfolio completely crash-proof, but it can reduce ups and downs significantly, which is exactly what you want as a beginner investor: stable growth. Let's go over the 4 main defensive sectors. Energy sector. Whether it's oil or electricity, everyone needs energy no matter the economy. Energy companies often pay steady dividends too, giving you passive income. So get ready for my stocks and ETFs recommendations now. This is the part where you may want to screenshot so that you can start adding these to your watch list. My favorite energy stock is ENB, Enbridge. Enbridge is one of the most consistent dividend paying companies, and I've been investing in this company for 7 years now. Here's a pro tip. You can set up dividend reinvestments so that every time you receive dividends, your broker automatically reinvests the dividends into the stock, so you get more equity. I can make a step-by-step broker setup tutorial next if you guys need it. Comment broker tutorial to let me know. Now, my second favorite energy stock is CU, Canadian Utilities Limited. This stock is very beginner friendly because it doesn't fluctuate much and it also pays dividends consistently. If you are investing from Canada, you can buy this stock directly with your Canadian dollars so you don't have to incur any currency conversion fees. Another Canadian energy stock is FTS, Fortis. You can also buy it with your Canadian dollars and get paid consistently in dividends. Fun fact, my first ever dividend payment was from this stock. It was 96 cents. If you prefer getting an ETF for the energy sector instead of individual stocks, take a look at NRGY by Global X. This ETF holds the top Canadian energy companies like Enbridge, Canadian Natural Resources, and Suncor. So investing in NRGY lets you invest in multiple energy companies at the same time. Bank sector. For banks, the reason to hold them in your portfolio during a market crash is pretty straightforward. Canadian banks like TD and RBC are still operating when the economy is bad because people would still be saving money for the rainy days. And when the economy is good, let's say when the government lowers interest rates, businesses would be going to banks to take out loans because of the lower cost of borrowing. So, bank stocks are relatively stable and usually pay generous dividends even during downturns. If you follow me on Blossom, you will see how much TD stock I'm holding right now. Blossom is the free social media platform for investors to follow each other. You can download it and follow me to see the stocks that I buy and sell in my portfolio. Link to download it for free is in the description below. Grocery sector. This is pretty straightforward as well. Think about the pandemic. People rushed to Costco and Walmart to fight for toilet paper, eggs, and detergent. A grocery stock that I currently own is ATD, Alimentation Couche-Tard. This is a Canadian stock that has been growing steadily and has always bounced back during a recession. I love my Canadian stocks, so another recommendation for the grocery sector is actually COSY, an enhanced high-income shares ETF that invests in Costco. You can buy COST, which is the Costco stock, if you are from the US, but if you want to invest in Canadian dollars and you want the monthly distributions, COSY is an option for you. If my explanation has been clear so far, please give me a like on this video. And finally, we have the healthcare sector. Whether the market is good or bad, people always need medicine and healthcare. So naturally, this sector stays strong when the economy is bad. Again, the easiest and safest way for beginners to invest in healthcare is through ETFs. ETFs allow you to buy a group of stocks at once without needing to research every single company. I'm watching a global healthcare ETF called XHC. This ETF gives you access to huge global healthcare brands like Johnson & Johnson, Pfizer, and United Health Group. These companies stay strong even in downturns because healthcare isn't something people can skip. So that would be my first investing goal for the market we're facing now, buying stocks and ETFs in 4 key defensive sectors. Now, the second goal is to continue dollar cost averaging into major market ETFs or your core stocks. Let me explain with my personal portfolio. I literally invest like a beginner because I like to keep investing simple and easy to manage. So my biggest holding has always been VFE, which is a Canadian ETF that tracks the S&P 500. For my beginners, the S&P 500 is like a basket of the top 500 companies in the US. So investing in the S&P 500 would mean that you are diversifying into 500 different companies. Investors like to refer to the S&P 500 as a US stock market. It's a long-term bullish asset. What this means is that if you look at any ETFs that track the S&P 500, their chart looks like a clear upward trend over time. But don't put all your money into the S&P 500 in one go. Instead, you want to use a simple but powerful method called dollar cost averaging, or DCA. Here's how dollar cost averaging works. Instead of trying to time the market perfectly, you invest a fixed amount of money into the same ETF regularly, no matter what the market is doing. It could be weekly, monthly, or bi-weekly, whichever works for you. For an example, you can invest as little as $100 into VFE every single month. Whether the market is up or down, you can set up an automation to help you stick to your investing schedule. It is 2025, so make sure you know how to use your mobile app to make your life easier. Again, let me know if you guys need a detailed broker setup tutorial. I can show you guys how I set up my automations on my investing app. When prices are down, like right now, my monthly investments let me buy more shares with the same amount of money. And when prices eventually recover and go up again, the shares I bought at lower prices will be worth a lot more. This is why DCA is the perfect strategy for beginners. You don't need to stress about timing the market. You naturally buy more when stocks are discounted. You build strong investing habits that pay off in the long run. I've been dollar cost averaging for years, and I can honestly say it has removed almost all of my anxiety around investing. If you stick to a simple ETF like VFV and regularly invest, your portfolio will grow steadily over time. And the best part is, during a market crash like we're experiencing now, dollar cost averaging lets you take advantage of low prices without needing to predict the bottom perfectly. So what are you waiting for? Do you want to start now and buy more shares at a cheaper price too? To summarize, we've covered 2 main investing goals that we should focus on during a market crash. 1, buy defensive stocks and ETFs in energy, banks, groceries, and healthcare to keep your portfolio stable. Dollar cost average into long-term bullish ETFs like VFV regularly to grow your wealth faster once the market recovers. Remember, investing doesn't have to be complicated. The simpler you keep your strategy, the easier it is to build wealth steadily. If this video helped clarify how you can start investing right now, hit that like button and subscribe for more beginner-friendly investing tutorials. Click this video over here for another Joyee Yang style investing for complete beginners tutorial. See you in the next video.